This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Pay raise. Walmart, long criticized for not paying its workforce enough, will spend $1 billion to hike wages for 500,000 employees this year. Another swipe. A judge rules American Express violated antitrust laws, sending shares of the company lower, making this the second major setback for the credit card company in just a week's time. And driving into debt. American automobile buyers are borrowing lots of money for new cars and trucks. Record amounts, in fact. Is it cause for concern? All that and more tonight on Nightly Business Report for Thursday, February 19th. Good evening, everyone, and welcome. Glad you can be with us. I'm Tyler Matheson. Sue Herrera is off tonight. Well, the largest private employer in the country is making a big investment in its employees. Walmart will hike the wages of its entry-level workers, more than a third of its workforce, to $9 an hour. That's above the federal minimum wage. Now, the world's largest retailer has long been under pressure from organized labor groups demanding higher pay and better benefits for workers. The company also reported earnings today. They topped expectations, but it did cut its sales outlook, citing the stronger dollar. Investors pushed shares of Walmart lower, likely worried about the bottom line implications of its worker pay initiative. It was, in fact, the worst performing stock in the Dow Jones Industrial Average today. Courtney Reagan now with more on Walmart and what was behind the company's big decision.
The country's largest private employer will spend $1 billion to increase wages for 500,000 of its 1.3 million workers, improve its scheduling, and offer new training programs for career advancement. Currently, only 6,000 Walmart workers make federal minimum wage. But starting in April, wages for Walmart's U.S. employees will be at least $9 and then at least $10 an hour by February next year. Department managers will also see pay improve.
Part of Walmart's problem has been concerns around inventories being out of stock. It's been about bad customer service, long lines at the checkout counters. There's been a lot of disgruntled workers. And frankly, this does sound like taking a step to kind of correct perhaps some of those past evils.
In an exclusive interview with CNBC, Walmart CEO Doug McMillon said the pay increases will ultimately bring sales dollars back into his store.
It'll play through retention, the ability to hire the talent that we need to hire. I'm confident those things will work their way through because we're investing to make them happen. But ultimately, we want associates who are so excited about taking care of customers, thanking them for shopping with us, things like that, that's got to show up in sales.
The cost of Walmart's wage increase and training initiatives are part of the reason, in addition to e-commerce investments, its earnings forecasts are below Wall Street's consensus. For the fourth quarter, Walmart's earnings did beat expectations, though revenues came in lighter than anticipated. Most noteworthy, however, sales and traffic at U.S. stores open at least a year, posting the strongest increases in 2 years. The retailer's chief financial officer said lower gas prices and better weather helped drive more customer trips to stores. However, Walmart's U.S. CEO Greg Foran says the congestion at West Coast ports is hurting some pockets of merchandise right now, and said if the labor contract issues aren't resolved, the problems for all retailers will worsen. Out-of-stock inventory has been an issue for Walmart in the past, though this time there's only so much the retailer can do about it. For Nightly Business Report, I'm Courtney Reagan.
Meanwhile, the luxury department store chain Nordstrom failed to impress investors after the closing bell when it reported earnings. The retailer's fourth quarter profit and full-year outlook fell short of estimates. Those sales last quarter did slightly beat those forecasts. Nordstrom shares dropped initially in after-hours trading, as you see there on that chart, following the earnings report. Liz Dunn joins us now to talk more about retail earnings, cheap gas prices, and consumer spending. She's the founder and CEO of her own firm, Talmadge Advisors, which focuses on the retail industry. Liz, always good to see you. Let's start with Walmart. Is raising wages the right thing for Walmart to do? And how do you expect it will affect the bottom line?
I think it is the right thing to do. If you think about, this in the context of the broader economy, one of the challenges we've seen is stagnating wages. And so I think this is a huge step. Walmart is the largest employer in the United States. And so this kind of step not only is just about Walmart, but it's also sort of forces the hand of other employers to perhaps match these wage increases. So I think it's the right thing to do. Investors obviously didn't like it today, but ultimately I do think that this will benefit Walmart and come back to them in the form of stronger sales.
One would presume that if some of these entry-level workers have a few more dollars in their pocket, they will be able to spend a little more, maybe even spend a little more at Walmart.
Absolutely. You know, I think it will come back to Walmart in terms of their sales, also an impact in customer service. Employees feeling a little bit better about working at Walmart and passing that on in terms of providing better customer service to customers, which should show up in the register. That was certainly Mr. McMillan's thought there. Let's just spend one more second on Walmart. What did you make of the numbers today? The comp store sales numbers were very favorable, really. Right, and this is the second time in a row, the second quarter in a row, we're seeing better results out of Walmart. And so I think it's notable, the fact that it's coming from traffic. Much has been said about whether or not gas prices are actually benefiting that low-end consumer, and I think this is a very strong sign that they are. So numbers were good. Obviously, the outlook a little bit disappointing. Currency is one factor there, and then, you know, this cost of paying people more. You know, let's talk a little bit now about gasoline prices and your thoughts about how much, if at all, those falling gasoline prices are translating into better sales at other retailers apart from gasoline stations. It seems like an awful lot of that money is getting saved or being driven towards paying down debt. What are you seeing? What are you sensing? Well, this is an impact that we should see for the lower-end consumer a bit more than the consumer broadly. The lower-end consumer has been lagging. They've really been struggling, and the recovery has missed this lower-end consumer. So, you know, saving perhaps and perhaps just a little bit of catch-up. But I would say we've seen a number of upside surprises from, you know, more mass and discounters. That's a little bit of, you know, the lower expectations. But I do think we're starting to see a little bit of pass-through for that lower-end consumer spending a bit more. Final question. Of all the retailers you follow, what stock is your favorite right now and why? You know, I really like Macy's and I also like L Brands. The reason I like these two, they're taking share. They also have a little bit of a benefit from an improving economy overall, but I think you really want to stick with share gainers in this market because we're not looking for tremendous growth in consumer spending. And so I think the share gainers are the places you want to be. Liz, thank you so much. Always great to see you. Thanks for having me. Liz Dunn, Talmadge Advisors. Well, that better than 3% drop in shares of Walmart that we were just talking about kept pressure on the Dow all day long, while tech remained strong and the NASDAQ stayed positive. All in today, the Dow fell 44 points to close at 17,985, back below 18,000. The NASDAQ did add 18. The S&P, it briefly hit an all-time high before it finished lower by 2 points, back below 2,100. Legal ruling against American Express. A judge says the company violated antitrust laws when it used a long-standing practice that steered customers away from using lower-cost credit cards. Now, the fees that American Express charges merchants, they are routinely higher than those of other card companies like MasterCard and Visa. American Express says it's going to appeal the decision and that the judge's ruling will hurt competition. This is the second setback for American Express in a week's time. Last week, Amex said its long-standing partnership with Costco, under which it is the only card the retailer takes, will end next year. Shares of American Express off nearly 2% today at 78.40. Well, now to the global markets, where Japan's benchmark Nikkei index hit a 15-year high. But the country grabbing all the attention is Greece, which submitted a proposal to its creditors for a 6-month extension of its loan agreements. But the plan was rejected by Germany. Michelle Caruso-Cabrera has more on the negotiations and what might happen at a key meeting of Eurozone finance ministers tomorrow.
So it finally happened today. The Greek government submitted a formal request for an extension of the bailout. The government refuses to say it's a bailout extension, but everyone else in the Eurozone is saying that is exactly what it is, and that's what they needed in order to come to the table. So here we go again for the third time in 2 weeks. All of the Eurozone's 19 finance ministers are going to gather in Brussels to look at this request by the Greek government. It's about a page-and-a-half document. They make several key commitments in there, and yet at the same time, there are a number of other countries in the Eurozone, Germany in particular, that feel the way it's worded, there's just too much wiggle room in there, that Greece maybe could back out of previous commitments and not stick to the program as that they have previously committed to, and at the same time, still try to get more money out of the Eurozone. So tomorrow's still going to be very, very contentious. The outcome is really key. If they don't finish tomorrow, then the rest of the Eurozone ministers, many of whom have to actually go back to their home countries and get this vote passed in front of their parliament. It's the equivalent of trying to get a vote in the U.S. Congress on a similar scale. If they don't get this done by tomorrow, they don't think they're going to have enough time to get this done before the official Greek program expires. That means they could be cut off by the European Central Bank, and that could be really devastating for the Greek economy. That would get them awfully close to potentially exiting the Eurozone. If they don't get a deal done by tomorrow, there's concerns about what would happen in the banking system of Greece over the weekend. Would there be runs on the banks? And would the European Central Bank have to make a big decision about whether or not they're going to keep funding the Greek banks? So bottom line, tomorrow is pivotal. For Nightly Business Report, Michelle Caruso-Cabrera.
Oil prices fell for a second day after a government report showed record-high inventories of crude. The Energy Information Administration said it was the sixth straight week where levels were at a seasonal record peak. WTI fell 98 cents today, off its session lows, though. It finished at $51.16. Brent crude was down 32 cents at $60.21. Oil and gas prices are watched closely, of course, by the nation's drivers who've been in showrooms buying up new cars. And to pay for all those new cars, they've taken on record amounts of debt, almost $900 billion as of the fourth quarter of last year. This according to Experian Automotive. Phil LeBeau is in Chicago now with a closer look at that report. Phil, welcome. We're seeing record auto loans, but who's borrowing might surprise people. Why?
Tyler, I think it will surprise people because the people who are borrowing the most in the fourth quarter were those who had the best credit. The super prime credit rated consumers did more borrowing than any other group, and that includes those who have subprime or deep subprime credit ratings. And we've heard this talk over the last several months, Tyler. The people with the poor credit are the ones who are driving auto sales. This report shows that's not the case.
We have heard those numerous stories about dealers selling new vehicles to those with weaker credit. Is it a concern? Is it a myth? What is it?
It is a concern, but it's not inflating sales overall. Look, in any market, you will see dealers who are selling vehicles to people who can't afford those vehicle payments. That's inevitable. That's going to happen all the time. But when you look at the repossession rates or you look at the delinquency rates on auto loans, they're below historical averages. So we're not seeing a problem right now similar to what we saw in 2008 and 2009. You know,
lots of different loan types. You hear them advertised all the time. No money down, 0% financing. Right. The 7-year loan. What's the most popular loan? Is the 7-year rising to the top?
It's not the most popular yet, but it's quickly becoming more popular. 6- and 7-year loans are what we're seeing most people take out. Most people are doing 6-year loans right now, Tyler, but increasingly 7-year loans are being offered.
That's really amazing. Phil LeBeau, thanks. Phil in Chicago for us tonight. Well, still ahead, Yahoo made a big move today to reinvent a critical part of its business. But will it work? We'll explore it. The labor market appears to be perking along. The number of Americans filing new claims for unemployment benefits, well, it dropped by 21,000 last week to 283,000. President Obama submitted his annual economic report to Congress, and it paints a positive picture of the economy over the next 12 months. The report clearly outlines his agenda, which includes overhauling the corporate tax code, increasing infrastructure spending, and some new trade agreements. John Harwood is with us now from Washington. John, welcome. Does the president propose these new policies in his economic report, or where?
Well, he reiterates what he proposed in the State of the Union and in his budget. So we've seen a celebration from the president over the accelerating job market, which created 260,000 jobs on average per month in 2014, heightened growth and better trends in unemployment, which is now, of course, below 6%. And the president's remedies are what he called middle-class economics, steps to improve middle-class incomes through labor market reforms, through new tax credits and tax benefits for average families, and higher taxes on the wealthy.
Republicans control the Congress. Will the middle-class economics play there go very far?
No, it won't go very far at all. But the president is trying to shape the debate that is accelerating now in the 2016 presidential race, Tyler, as well as the Congress that meets the next president, his successor. He's trying to move the ball down the field, maybe get some things, but not very much of this agenda.
You know, obviously the GOP has their issues with the president, but some in his own party have issues with him, specifically, I think, over corporate taxes and expanding trade. Is he making his own party unhappy?
Yes, he's making both parties unhappy, actually, because Democrats don't share his priority for reducing that top corporate tax rate from 35% to 28% as he's proposed. He'd have to close a lot of loopholes to do it. That's very difficult to do. The one thing that's more likely to get through, which is Democrats are very opposed to, are the Trans-Pacific trade deal and the trade deal he's negotiating with Europe. The president's trying to make the argument that the problem that the labor movement is objecting to, jobs going overseas, downward pressure on wages, is a result of globalization, but not the trade deals themselves. And he says he's going to get enforceable standards to prevent a race to the bottom in these new deals.
John Harwood in Washington, thanks very much. John reporting from Capitol Hill or nearby. 3 companies returning more cash to shareholders is where we begin tonight's market focus. Coca-Cola, T. Rowe Price, and Colgate all announced hikes to their quarterly payouts. Coke's is up 8% to 33 cents a share. T. Rowe upping its dividend to 52 cents a share. Plus, it declared a special dividend of $2 a share. And Colgate's now 38 cents a share, and it will buy back up to $5 billion in stock. T. Rowe Price up 1.5% today. Coke was up almost 1%. Colgate shares were down about 0.5%. Priceline's results out today beat on both the top and bottom lines, bolstered by growth in hotel and car rental reservations. The travel booking site also said it would buy back an additional 3 billion shares. Now, it did warn investors about the impact of a stronger dollar. Still, Priceline popped about 8.5%. Look at that price, $1,218.05 a share. Well, all of those aggressive discounts helped T-Mobile deliver strong results for investors. The wireless carrier saw revenue rise as it managed to add more than 2 million subscribers in the quarter. The company's chief explained how he wants to continue to invest in new subscribers.
I was accused in the second half of last year of thinking more about customers than shareholders, which, by the way, is you can judge from the balance. We've shown that profitability will follow. We gave huge guidance, which I think is the positive news that's coming forward. And this Un-carrier revolution is one by one taking all the things that everybody hates about wireless and eliminating them structurally forever.
Shares there up almost 3% today to $31.85. It was a mixed quarter for Hormel, but the seller of Spam, Skippy, and my favorite corned beef hash raised its earnings outlook for the year after lower meat prices and continued demand for turkey products drove margins higher. Shares up more than 2% today to $57.65. Well, the government is suing to block the merger between Sysco and U.S. Foods, the nation's 2 largest food distributors. Regulators think the proposed $3.5 billion merger would hurt competition in food distribution and raise prices. Shares of Sysco off 3% to $38.56. Well, Yahoo wants to show that it can make mobile work. And that's what CEO Marissa Mayer was trying to prove at the company's first ever Mobile Developers Conference today. Investors did seem pleased, sending shares up more than 1.5%. Our Josh Lipton now with a look at why it's so important for Yahoo to get this part of its business right.
Good morning and welcome. We are so excited about today.
Yahoo's CEO, Marissa Mayer, has said that when she first joined Yahoo in 2012, the mobile business there was a hobby, not a job. These days, Mayer is working hard to change course. That's why today she hosted Yahoo's first ever Mobile Developer Conference, where the company announced a suite of products for developers and touted Yahoo's mobile success.
This reinvention of our products for the mobile space is perhaps the achievement that I'm most proud of during my tenure as CEO. And that investment has paid off. We've seen tremendous growth in terms of users, revenue, and time spent. And not only have we seen that growth, we've actually seen an outpacing of our historical rate, which, by the way, wasn't that hard. But we've also actually outpaced the industry rate.
Meyer said that Yahoo generated more than $1 billion in mobile ad revenue last year, making the company the third largest ad company in the world. Still, Meyer has a lot more work to do. This year, Yahoo's mobile ad revenues will account for about 4% of the overall market, compared to 35% for Google and nearly 20% for Facebook.
The challenge that she's had is that even though they've had a lot of progress, they still lag the industry in terms of mobile adoption and mobile revenue. They're still about half of where they probably should be.
And we are so proud of what we have to offer you here today.
It's critical that Meyer keeps the momentum in mobile going. Businesses are expected to spend $28 billion this year on mobile ads, according to research firm eMarketer. So the stakes are high, and there's a lot of money on the line. For Nightly Business Report, I'm Josh Lipton in San Francisco.
Coming up, Uber and Lyft, two popular startups that are changing the way people hail cabs, are facing legal challenges that threaten their business models. We'll explain. Some of the West Coast ports are reporting now lower cargo volumes for January. The ports of Seattle and Tacoma said imports fell 21% compared with the same month a year ago. Port of Long Beach said volumes were off 24%. The Port of Los Angeles will release its numbers next week, and it said it expects the report to show steep drops. The decline is being attributed to that ongoing labor dispute and slowdown. Uber, the ride-hailing app that's changing the taxi industry, is expanding the amount of capital it expects to raise by $1 billion, and that brings the total current round of funding to just under $3 billion. The startup decided to increase the round because of high demand for its shares. The company has also seen its revenue growth accelerate in recent months. Well, as Uber grows, so do its challenges, and some of those challenges could end up bringing legal cases. Uber and Lyft facing lawsuits now brought by drivers in cities that could dramatically increase the costs of doing business and potentially change their business models. Kate Rogers reports.
The model that has allowed the sharing economy to flourish could change dramatically as decisions are awaited in two lawsuits filed against tech startups Uber and Lyft in California. At the heart of the cases, which seek class action status, is whether their drivers are independent contractors or employees. The plaintiffs argue they're employees and are seeking reimbursement for things like gasoline and vehicle maintenance. If judges rule in their favor, costs for transportation technology startups Uber and Lyft could increase significantly to include things like health insurance costs, Social Security, unemployment insurance, and wage protections. Uber and Lyft argue their technology platforms providing services to drivers as well as passengers. In Los Angeles, an Uber driver who asked us to withhold his name says he's spending $80 a week on gasoline, $30 a month on car washes, and $300 a year on maintenance. His reimbursement on those costs alone could near $5,000. He may be an independent contractor, but feels like more of an employee, as he claims Uber has control over the jobs he accepts.
Really, what I feel that I am is an employee, given that Uber controls everything I do, from where I go to how I can look, how I can talk to people. And every job that I take, I'm even forced to take it, even if I'll lose money on the contract. Otherwise, I'm fired. So in that way, too, I feel like an employee because I'm not really given a choice as to what my duties are.
But not all drivers are pushing for benefits. Brooklyn-based Lyft driver Robert Henderson says he likes the convenience of being an independent contractor, although admittedly he receives health insurance through his wife. Becoming an employee would change his outlook.
Because I will feel it's an obligation, and I don't want the obligation feeling. I like the fact that whenever I'm ready to work, I could work.
But attorney Shannon Liss Reardon, representing plaintiffs in both cases, says flexibility and employment status aren't mutually exclusive.
That's a common refrain that, oh, the workers like being their own boss, they like being an independent contractor. But the truth is they're not independent contractors. They're working for these companies, they're following these companies' rules, they're not getting paid proper wages and employee benefits.
Uber and Lyft declined to comment, and while the decisions could be limited to drivers in California, Liz Reardon plans to appeal that, seeking nationwide class action status, which could be a game changer for other sharing economy startups across the country. For Nightly Business Report, I'm Kate Rogers.
And finally tonight, China welcomed the year of the sheep today, ushering in the Lunar New Year, part of the Chinese tradition. The sheep has a bad rap. Some Chinese believe the animal brings bad luck, but apparently not for U.S. investors. Over the past 50 years, sheep has been the most profitable year for the S&P 500, time and again, with average annual returns of about 21%. It is the third most profitable year for the Dow, and we're not pulling the wool over your eyes. That's Nightly Business Report for tonight. I'm Tyler Mathisen. Thanks for watching. Have a great evening, everybody. We'll hope to see you right back here tomorrow night.